Alright guys, so I have big economic updates for you today. We're going to talk about Argentina. Milei, he has promised the moon, but things are breaking down further. We also have to cover China and the Eurozone because a trade war is now brewing. This decoupling between the East and the West is going to get worse in 2024. And finally, we need to dispel the myth of a resilient US economy. It's one of the biggest lies being spun in the mainstream media that we need to debunk. And once you know this, you'll realize there's still a ton of alligators lurking beneath the surface. But let's talk about Argentina first because the situation there is truly dire. Annual inflation is over 160%, and just in December alone, it has reached 30% monthly inflation. That means a loaf of bread for 100 pesos today will cost 130 by next month. People are getting poorer and poorer, and confidence in the currency has totally collapsed. And this crash isn't just restricted to food and gas. The crisis has hit the housing market as well. Pesos are becoming increasingly worthless in the country. From the FT, homes empty and tenants homeless as Argentina's peso crisis hits rentals. 1 in 7 rental homes are left vacant and the homeless rate is rising fast. When you have inflation so high, no one wants your currency. Landlords in the country, they are rejecting the Argentine peso. 70% of long-term leases today are priced in dollars compared to 27% a few years back. And this makes total sense on the street. But this poses a big crisis for Javier Milei. He has promised radical change, however things are about to get much worse. Argentina's debt problem is about to collide with the horrible shortage of US dollars. The government's debt burden is starting to rise and is rising fast. Argentina owes dollars and euro bondholders a ton of money. They have $1 billion worth of debt outstanding today. However, by January 2025, this amount will triple to almost $3 billion, and the majority of this are interest payments alone. This puts enormous pressure on Malay's government to conjure up the dollars. He can't afford another debt default. That would simply devastate the economy. There's a big problem with trying to dollarize Argentina. You can't do it from thin air. You need to increase the supply of US currency to match the enormous demand. Argentina doesn't own the Federal Reserve. They don't have a Jerome Powell. They can't print the reserve currency. So there are only two ways to get the greenbacks. You either increase exports to the world to earn dollars or you borrow them from investors. It's not looking good either way. Argentina's balance of trade is negative month after month. They are bleeding dollars instead of accumulating a surplus which they desperately need. More dollars is leaving the country than coming in, so the only route left is to borrow the reserve currency from the world. It's not just bondholders they need to pay back, but their suppliers as well. But no one believes Argentina can pay back their debts. Buyers shun Argentina reconstruction bonds for second straight week. The central bank sold only 57 million of 750 million notes in their second attempt. 92% of the bonds went unsold. Importers aren't buying the bonds and suppliers don't want it either. You buy these bonds in pesos and the payout is in US dollars when they mature. So on the surface, it looks like a very good deal. That is if they even mature. There's a very good chance that they might default. And if they do, you could get back nothing, not even the pesos that are inflating away. Milei is trying to use financial wizardry to pay down the debt. More accurately, he's trying his best to roll over the debt, the classic kick the can down the road strategy. From Bloomberg, Argentina proposes peso debt swap that may top $71 billion. Now, this is local debt denominated in pesos. Milei is trying to engineer the biggest domestic debt rollover in Argentina's history. He is trying to lure the banks to roll over their existing notes for new debt that matures further down the road. And here's the carrot he's using. The new debt will be CPI-linked bonds. However, I believe it will be a big failure. Firstly, CPI inflation doesn't really reflect reality on the ground. It understates the true inflation disaster, and I'm sure the banks aren't that dense, they're not that stupid. Secondly, if inflation is at 30% per month, you want your cash now. You want to take the money and buy US dollars, real estate, or even gold, assets that preserve their value. Looking at just their local debt, we can see a bigger inflation disaster coming. In 2024, there's over 57 trillion pesos of debt due. That's equivalent to 71 billion US dollars. If Milei can't roll over the debt, you have to pay back bondholders 57 trillion pesos. That is a lot of money flooding the economy. What do you think that will cause? More peso devaluation and higher inflation is coming. So you can see Milei's desperation. He's scrambling for US dollars while trying to negotiate with local bondholders. Let's not forget China also put away the yuan swap line. There's no backdoor solution using the Chinese yuan for imports anymore. People on the streets are also running away from pesos. Instead of keeping their money in time deposits in the bank, they are keeping more cash on hand. Since Milei took office, confidence in the currency has collapsed. Money in checking and savings accounts jumped by almost 50%. Term deposits have stagnated, and it's really easy to understand why. You could wake up tomorrow to another devaluation. Your holdings might be cut in half again in a single day. So savers are pulling out their money, pulling out their pesos to buy dollars and other assets now. The only hope left is the US throwing Argentina a swap line, a dollar lifeline where they can get instant liquidity to solve their problem. Milei's job is near impossible now. He needs to rebuild the economy while solving inflation. Both are important problems, but inflation is far more urgent. He can't keep borrowing money endlessly. The country's total sovereign debt exceeds $400 billion, of which 110 is owed to the IMF. If America doesn't step up to help, it's very likely that Argentina will default. It's just a matter of time now. And this brings us to our next economic crisis. Let's talk about a disaster brewing between China and the Eurozone. Ever since the Ukraine war started, tensions between the EU and China, they have just escalated. Financial decoupling has begun, and this is spreading fast towards bilateral trade. A few months ago, the EU launched a probe into Chinese EVs, and the concern was China underpricing their electric cars, heading to Europe and stealing market share. A Chinese EV costs less than 32,000 euros, while one made in Europe was well above 56,000. Price matters today, especially when a recession is coming for the world, is coming for the Eurozone. Consumers will prefer to buy the cheaper product. We said before that China will retaliate, and they have now fired a warning shot. It's a mild warning, but it's a clear sign of trade escalations happening. In retaliation, China is now probing EU liquor, including brandy. Now, I'm not an expert in French cognac, but the financial impacts are rather obvious. It's sending Eurozone distiller stocks like Remy crashing down. We are talking about a 10% drop, so it's quite significant. Now, it's easy to dismiss this as nothing, but it's likely just the first salvo China is firing. They want to negotiate with the EU. Trade wars hurt both sides. Now, if the Eurozone stops Chinese EVs from entering the country, that will hurt China's economy for sure, but it will also inflict high inflation on local consumers. We call this a warning shot because the retaliation is rather small. Comparing the brandy probe versus the EV probe is a world of difference. The EU exports only $1.6 billion worth of brandy to China. The Eurozone, however, imports nearly $13 billion of Chinese EVs to Europe. The EV's probe is 9 times bigger than China. So this is a message that Beijing is sending. We are targeting a small product today, but if you ban our EVs from coming in, then we could escalate things further. It might be brandy today, but it could be cars and even luxury products tomorrow. If a trade war happens, the EU will be hurt badly because they still need China to keep buying stuff. Because of sanctions and trade tariffs from the West, China's economy is starting to restructure. Since the fourth quarter of 2022, China's GDP growth have been powered mainly by local consumption. The net exports in yellow color haven't been contributing to China's growth. They have been buying more from the world than selling to the global economy. Growth is coming from the local Chinese people. However, for Europe, the economic situation is extremely dire. Manufacturing and services PMIs have continued contracting well into Q4 last year. In other words, their economic output is starting to shrink. The longer it stays in this contraction zone, the bigger the odds of a recession. PMIs, their leading indicators, and the numbers have been negative for far too long. So it is important to watch out for this trade war. If things escalate, Europe would most definitely sink into a recession. China will slow down as well, and that might be it for the global economy. The world is so synchronized today. If the second and third largest economies go at it, they have a trade war, everyone will feel the pain. And speaking of pain, it's time for reality check. It's time for me to play Mythbuster because a ton of information coming out is really shady, especially from the United States. The narrative we keep hearing is a strong economy and people getting richer. The Federal Reserve is about to cut interest rates because inflation is no longer a problem. But the devil is in the details. This is where we need to peel back the data and realize the big deception at play here. We are being told half truths, guys, and only fed the data they want us to see. And according to Janet Yellen, everything is fine and everyone else is a fearmonger. Remember, this is coming from the same person who told you inflation is transitory. Yellen declares US economy has achieved soft landing. Real wage increase means American workers are getting ahead. Now, if you're from the US, please leave a comment below, guys. Let me know if things are as rosy as Yellen says. At least to me, inflation is still a big problem and wages are definitely not catching up to reality. And this is where I need to tear into the jobs report. For many months now, we have been getting announcements of big increases. And if you only read the headlines, you're inclined to believe that everything's hunky-dory. From CNBC, US payrolls increased by 216,000 in December, much better than expected. Job growth in America is phenomenal, beating analysts' expectations. And that's why we keep seeing stocks rally over the past few weeks. It's bullish news after bullish news. And if we look at the past 12 months, job creation still looks very strong. It's not as high as before, but the print is still very strong. Despite the news of layoffs, overall people are still employed. But that's just on the surface. The jobs numbers keeps getting revised down. For example, October was revised down by 45,000 jobs. November was also revised down by 26,000. Those aren't coincidences. 10 of the past 11 jobs reports have been revised substantially lower. That's like 90% of the time. This is either gross incompetence or something really sinister going on. No one really pays attention to all these revisions, right? But that is the true reflection of the economy. We can't ignore it. Pulling up the chart, we can see how ridiculous this entire situation is. 10 out of 11 months had revisions down. June, for example, was revised down by 100,000 jobs. That's a 50% drop in openings. Now, you and I might not take these numbers seriously, but the market does. They see the job print and to them it looks like the economy is booming. That affects investment decisions going on. You can slap a lipstick on a pig, but it is still a pig. And that's what these job numbers are. People are being tricked by the initial print. This is perception control at its finest. Now, I want to dig a little deeper into the numbers, comparing the payroll numbers in green against the employment household survey in red. We get a very big discrepancy. There is a big gap of 210,000 jobs. Where did those jobs suddenly come from? According to the household survey, December actually lost jobs compared to the month before. But the payroll numbers keep hitting higher and higher without pause. Which graph are we supposed to follow? Curiously enough, things began to diverge in April 2023. Everything went haywire. I'm looking at two completely different economies even though it's the same country. And where is this job growth coming from? It's coming from government, healthcare, and hospitality. It's not from manufacturing, technology, or even finance. And I won't be surprised if the majority comes from government positions. Is this genuine job growth? I don't know. Government jobs don't add to the supply of goods and services. These aren't exports out to the world. So there's a big problem here. We have to dig beyond the surface. If we look at inflation, the numbers are coming down. Estimates for CPI in December is 3.2% and core inflation is at 3.8%. So things are looking really rosy. But the jobs report, the real jobs report, is telling us a totally different story. The higher prices are still going to stay. So while inflation is coming down, the higher prices are still going to stay. We are having disinflation and not deflation. There's a very big difference here. Now, I'm not saying that a recession will come in 2024. They can keep deficit spending up and keep throwing positive report after positive report. However, we must look beyond just the headlines. But let me know what you think, guys. Can Argentina get out of this mess? And do you believe the crazy jobs report? What else are they hiding from us? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.